Then we go to the third level, and that is going to be equity investments that gives us control. That's the third level. So if we have equity investment that gives us control, this is the real thing. But we need to then ask ourselves, what the heck is control generally? It's pretty simple. Control is the power to govern the financial and operating policies of the investee. So here we have the power to govern. That's the key word. Power to govern. We call the shots. We decide how the heck finances should be made. We decide who the heck can be employed, who cannot be employed. We decide what products to produce, how we can control cost. We call the shot. And that is equity investments. When we have control, therefore, it means that there are a couple of things that we need to undertake. Number one, it means that here we're going to be applying full consolidation. What does that mean? It means that because we govern the financial and operating policies of the investee, all the assets and liability of the investee will be added to the investor in the consolidated financial statements. So the assets and liabilities of the investee shall be included in the consolidated financial statements of the investor. In this case, we will call that a parent company. But I want you to be careful, because although that is the rule, there is an exception to that rule. So please stay with me carefully. I'm going to show you that in a moment. Now, how do we get control? How do we get the power to govern? There is a default way we can get a control. Generally, we can get a control. How control is obtained? Generally, by default, we can get control by, number one, direct acquisition of more than 50% of the voting rights of the company. Okay, direct acquisition of more than 50% of the voting rights. More than 50% of the voting rights in the investee. That's the default way. Give me a sec. Let me pull this to the next slide so I can have a better space of writing. That's the default way. That's the organic way to get control. Okay? That's the organic, or if you want, the default way of gaining control. We directly go there, boom, acquire 50% or more. What does that mean? For instance, if we have a company and the equity is $0.75 at 100,000. Please stay with me carefully. Stay with me carefully. This is the investee firm. Their equity 0.5. Now, always note that the 0.5 each in the bracket here is the nominal value of the shares. Is the nominal value of the shares. So please stay with me. So we have an investee firm in which their value is this, and then we go in there and acquire a certain number of shares in the company. So the investor acquires 100,000 shares. Let's see, have we gained control or not? Now, I want you to stay with me, because don't let something spew in your head. to think that because this is 100,000 shares, it is similar to this. No, it's not. Because the nominal value of the shares in the investee firm is what? 0.75 each. So before we determine whether we have gained control or not, what do? We need to calculate the number of shares of the investee firm. So the number of shares of the investee is going to be the total nominal value divided by the nominal value per share So what do we have? $100,000 divided by 0.75. That gives us the number of shares.
133,333.
So 133,333. So this is the number of shares in the investee firm. I'm bringing this up because there are times the examiner will not tell you how many percentage we have acquired in the company. All the company will tell you is the number of shares we have acquired. So how then do we calculate the percentage of ownership? This is how the heck you do that. So if the number of shares in the investee firm is 133,333, and we have acquired 100,000, what is the percentage of ownership? Will be 100,000 divided by 133,333 times 100. What do I have?
75%.
75%. So that is how we calculate the percentage of ownership. Now, 75%, is that above 50%? Hell yes. So what do we have? We have control over the company. That is the first way of obtaining control. Direct acquisition of more than 50% of the voting rights in the investee. 99.999% of the time, that's all your question is going to be about, that the company has made a direct acquisition of more than 50%, 99.9% of the time. But there are other ways that an entity can obtain control. Number 2, indirect control. Stay with me carefully. This is where an entity has a subsidiary who takes control over another company. Stay with me carefully. This is where the subsidiary of a parent entity takes control over another entity. Ooh. And so this is where we smell the spirit of complex group structure level exclusively 99.9% of the time for corporate reporting students. So what do we mean by indirect control? This is what we mean. Note that there are cases where a company will have a subsidiary, then that subsidiary also operates. So that subsidiary will also go and acquire another company. So the question then is, how do we determine whether we have control? So let me give you an example of what I mean by that. This is what I mean. So we have a parent company who has control over a subsidiary. And so the subsidiary, they own 75% of that. The remaining ownership in the subsidiary is what is referred to as non-controlling interest. Don't worry, we'll get into that later. But the remaining ownership is going to be non-controlling interest. Then the subsidiary we have also goes ahead to acquire another company. In that case, so now we have company A, company B, and they go and acquire 60% of that company. Please be careful here. Be careful here. The principle is that any investment the subsidiary makes the parent entity and NCI have their share of ownership in that investment. Please get the grammar. Any investment the subsidiary makes, the parent and the NCI of the subsidiary each have a share in that investment. So if I go back to my illustration here, technically, the parent controls the subsidiary. But then the subsidiary also controls another company, and that is sub-subsidiary. Now, I will come to the fact that although this subsidiary has a control, they cannot prepare consolidated financial statement. We will come to that in a moment, but stay with me here. So now the subsidiary goes and acquire 60% of another company. So the question we ask ourselves is, does the parent entity has control over the second company, or they don't? By default, they have control. Why? Because they control the company that controls the second company. So although they don't directly have any investment in the company B, the sub-subsidiary, they will still consolidate their financial statements. Why? Because they control the company that controls them. So the question we then have to ask ourselves is, what is the controlling interest in the sub-subsidiary? What is the controlling interest in the sub-subsidiary? Principal. What the heck did we say? We said any investment the subsidiary makes, the parent and the NCI of the subsidiary each have a share of that investment. Okay. So how many shares of the 60% belong to the parent company? It's going to be 75% of the 60% investment they make, because we own 75% of that company. How much we have? What the heck?
45.
45%. So do not say, it's 45%. It's below 50, so we can't consolidate. No, we will. Why? Because we control the company that controls them. So that the non-controlling interest in the sub-subsidiary is the balancing figure from 100. Which is going to be what? 55%. That is what we mean by indirect control. So although it is 45%, and it appears that, 45% there, we don't have control. No, we have. Why? Because we control the company that controls them. So we will still consolidate the financial statement of the second company that is controlled by the company that we have invested in. And our share of their profit will be the 45%, and we'll get into this later on. And we will take that when we are doing our consolidation. But that is the idea about indirect control, where the parents get control of another company through the investments they have in a subsidiary. Yes, Evelyn.
Nhyira, what happened to the NCI's share of the controlling interest? Because if I got you well, you said any investment the subsidiary makes, the parent and the NCI of the subsidiary each have a share of that investment.
We will come to that. We will come to that later. For now, we are not interested in that. We'll come to that when we are dealing with non-controlling interest, and we'll see how we use the data for that. So that is the second way that we can obtain control, indirect control. Another way is through what I love very much, and that is through, legal regulatory requirements. What does that mean? So this is where an entity obtains control of another company with less than 15%, 50% acquisition due to their size. It refers to the circumstance where the investor entity obtains control of the investee with less than 50% acquisition due to the operation of the law. That's the beauty of this one. Now, what the heck does that mean? It means what it means. What else do you think? It means that here, for example, MTN PLC is a listed company. So MTN is a listed company. If it's a listed company, it means that it has better corporate governance systems in place. You cannot beat it. It's a listed company. So it has a better corporate governance in place. Not only that, it'll be better regulated because, I mean, the regulatory requirement for listed companies is very different. You need to, the Security and Exchange Commission, it's on you. The National Communication Authority is on you, and other National Insurance Commission, all the other guys, they are really on you because you're a listed company. So because MTN is a listed company, it's big, has a large market cap, they could decide to go and acquire, please, this is just an example, okay? Go and acquire one of these, you know, other telcos, which I don't know if they exist again, but let's just use it for example, Surfline. So MTN can go and acquire a share in Surfline. Maybe they just acquire whatever, 30% of Surfline, because Surfline serves certain kind of customers in certain locations that MTN doesn't want to get into, but they still want to chop a bit of the cake. So they invested 30% in Surfline. 30% means MTN has what? Significant influence from our discussion, isn't it? So as per the standards, MTN will account for that investment in as per equity accounting in accordance with IAS 28, investment in associate. But you see, you don't just get up and acquire. So what will happen is that the regulators will say that if this deal will be approved, then Surfline must agree to become the subsidiary of MTN PLC. That's the operation of the law. And if that is the law and that is the directive from the regulators before this deal continues, then MTN has control of the company and they will consolidate their results, not because they have more than 30% of the, more than 50%, but because of the operation of the law. That is another way we can get control. That's another way we can get control. Then the last one will be an arrangement with existing shareholders to transfer their voting rights. That's the last one where we can obtain control. What does that mean? Again, so let's go to another scenario here. Pretty simple. So let's say that we have a company. So whatever the heck, let's say we have Nanado Limited, and we invested in Nanado Limited. So our company is called whatever the heck, KK Limited. And so we buy 25% shares in Nanado Limited. Okay. But then the other owners include the following: Kenofori Limited. They own 30% as well. Then we have another investment, JMD. They own 25%. Then we have another shareholders, and that will be whatever the heck, NB Limited. And what will be the remainder? 50, 80, 20%. So stay with me carefully here. This is us KK Limited, we own 25% of the company. By default, 25% of the company gives us a representation on the board. So that is, again, significant influence. Sounds good? It's significant influence. It's giving us the right to participate in the operating and policy decisions of the company, right? But then we sit down with the other investors. So we speak to Kenofori Limited, we speak to JMD Limited, we speak to NB Limited, and we are like, hey, listen, all of you, you cannot make any decision. Why not transfer your decision-making authority, your power, your voting right at the board and at shareholders meeting to us, so that we can better make decisions for you? So we spoke to, NB Limited, and they said, we ain't doing that. We want to manage on our own affairs. Okay, go ahead. It's your own life. We speak to JMD Limited. Then JMD Limited also said, we're not going to do that. We want to retain our voting rights and decide our own thing. But we speak to Kenofori Limited, and he was like, they are like, what the heck? Yeah, I'm not even interested in this investment. I'm busy doing other things. So you dare make the decision for us. So they say yes. So by agreement with Kenofori Limited, they now transfer their ownership, their voting rights, to us. So now our voting right is going to be what? 55%. By that arrangement and them transferring their voting rights to us, their representation of the board decision to us, we now have control over the company. That is the idea about arrangement with other shareholders. There are other indirect ways of obtaining control, because sometimes control can be obtained premised with certain conditions. And there are other ways that controls can be obtained, but these are the default ones that we are going to be talking about later on as we solve some questions. Something will come up, and then maybe I'll show you about it. But this is how we obtain control.